thanks for this opportunity. It's always one of the favorite parts of my job to actually interact with our financial planners. Unfortunately, I don't get to see you guys in person, but it's still, an opportunity where I actually get to share some of the proposed legislation changes. So it's fantastic to be here in that sense. Just in terms of what Ashraf said, I can vouch for that seamless client journey. I'm particularly proud of the way that we've listened to our clients and we've managed to incorporate a seamless tax-free investments journey as part of our digital onboarding process. So thanks for that, Ashraf. As many of you would know, we recently had the Taxation Laws Amendment Bill that was published a few weeks back. And as usual, there's lots in there to try and unpack. What I've done is I've pulled a few things out that I think is pertinent to financial planning and that I believe our clients will ask questions around. So I just wanted to share some of that with you so that you are equipped, so that if any of your clients actually does have any questions around it, that you are able to actually address some of them. The first issue that I want to chat about is that was introduced in the Taxation Laws Amendment Bill was the purchasing of various annuities. And what it is really is allowing retirement fund members to use retirement benefit to purchase various annuities on retirement. Firstly, I'll get into some of the issues and what the proposal is about, but firstly, what it means to actually do this is it's going to require quite a few changes in terms of the definitions of in the income tax with regards to the pension fund, pension preservation fund, provident fund, and provident preservation fund in the Income Tax Act to allow for various types of annuities. Currently, the annuity can be provided by the retirement fund in one of three ways: either paid directly by the retirement fund to the retiring member, purchased from a South African registered insurer in the name of the fund, or purchased by the retirement fund from a South African registered insurer in the name of the life of the retiring member, or otherwise known as a member-owned annuity. Okay, why is this coming about? What is the issue? The definition in the Act talks to allowing the purchase of an annuity, which has often caused confusion in the industry as to whether a retiring member can purchase multiple and various annuities. And you'll find that a lot of the retirement funds actually have different rules in terms of whether or not they'll allow you to purchase multiple annuities. And I know that we've spoken to a lot of them when default preservations and annuities came about, and this was an issue faced by a lot of our retirement fund clients. The proposal is to allow retiring member to purchase a combination of the above type of annuities, including a combination of a living annuity and a guaranteed annuity or an income for life. Okay. The condition, however, is the only proviso to purchasing multiple annuities is that the retirement benefit used to purchase an annuity must be more than 165,000 Rand. Okay. Should this proposal go through uncontested, it will become effective on the 1st of March 2022. So it is important that the value of the annuity that you purchase is with 165,000 Rand, which interesting enough is aligned with the 2/3 that you must commute if your value is more than 165,000 Rand when you get to retirement. Having said that though, you know now with a living annuity that you can actually commute it if the value is less than 125,000 Rand. Okay. The second one, which is quite controversial and there's been a lot of commentary regarding it, is with retirement funds and immigration. You would know that as of 1 March 2021, they introduced this new concept of that you need to, in order to access your retirement annuity or your retirement fund when you leave the country, you have to have been non-tax resident in South Africa for a period of 3 years. Okay. Now what they're looking to do is to introduce a new piece of legislation that introduces deemed taxation. What is that all about? Well, SARS has indicated that they're not happy to forfeit tax when the retirement fund member is no longer tax resident, Members are entitled to reduce their taxable income every contributing year with a contribution tax deduction, and Treasury wants to ensure that there is some form of tax neutrality when a member is no longer tax resident. So the issue that they have there is that you would know that when you're building up to your retirement and you're contributing towards a retirement fund, okay, you are entitled to a contribution tax deduction. The issue that they have is that when you leave South Africa, okay, and you then decide to access your funds and there's taxation on the lump sum, if you choose to access the lump sum, in terms of double taxation agreements and depending on the tax jurisdiction in the country that you have left to, okay, in some instances, you will pay tax in the other jurisdiction. And in that instance, because of the double taxation agreement, SARS will not get all of the tax that they've entitled to. However, you have benefited from the contribution tax deduction building up to retirement, okay? And what they want to do is they want to introduce some form of legislation to ensure that they are not shortchanged, okay, once they've given you the contribution tax deduction when you actually access those funds at a later stage. And what is the proposal? Well, it's to change tax legislation to ensure that when an individual ceases to be a South African tax resident, his or her retirement fund benefit will be subject to tax in South Africa in terms of either the retirement or withdrawal lump sum table. The member will be deemed, this is really important, the member will be deemed to have retired or to have withdrawn their retirement benefit the day before they cease to be a South African tax resident. The onus of providing SARS with evaluation on that date as well as notification that they have ceased to be tax resident will fall on the member. So it's important to note that it creates a deemed tax event the day before you're no longer tax resident, okay? You don't actually pay tax at that point, okay? Tax will be payable only when it's due to the member and that member receives a retirement benefit via withdrawal or retirement fund lump sum. Okay, tax will be applicable as per the retirement lump sum table, and the member will receive a tax credit for any deferred tax levied the day before they cease to be tax resident. Okay, the intention is for this to also become effective 1 March 2022. So what we mean by that is, if on the deemed tax event, if your benefit was hypothetically 100 Rand, okay, and your deemed tax was 10 Rand, okay, and you get, years down the line, you decide to access your funds, okay, and let's assume that the tax payable is 30 Rand, okay, what will happen is you won't have to pay the 10 and the 30, you'll get the tax credit on the 10 and you'll have to pay the 30. Now, we know what SARS is actually trying to do and what they're trying to accomplish, okay? The problem with this type of thing, well, there's a number of problems with this. And I can tell you that there are quite a few industry bodies that have commented on this and have raised a number of issues in terms of this. The one obvious one is in terms of double taxation agreements. We are party to double taxation agreements. We've signed that. And the problem with this is that we are introducing a tax event, okay, that almost circumvents the double taxation agreement, where we're trying to recoup tax, okay, before that event actually occurs, okay? I mean, that's just one issue. The other issue is that we're introducing a deemed tax event, but yet the member is no longer able to access those funds by introducing the 3-year period in which they have to wait. Okay, I can tell you there's a whole list of contentious issues with this proposal. Okay, and unfortunately, we don't have the time to go through all of it. Okay, but what I can say is that the various industry bodies have raised many concerns in terms of this. So we'll see what happens when the proposal actually comes out. The next proposal comes out, the next bill. Okay, the next one that they've introduced is taxation of annuities. Okay, and what is the issue here is when an annuitant receives an annuity payment, both, interestingly enough, compulsory annuities and voluntary purchase annuities, the entity paying the annuity, okay, applies the PAYE income tax table. The problem identified with this method is that if the same annuitant had multiple sources of income, they would be undertaxed by the paying entity, which would result in a potentially high tax pay-in on assessment, Many annuitants are not in a financial position to pay in tax, and they have not accounted for this. This concept was first introduced a few years back when there was an issue around divorce and death of members, where the spouse would decide to continue their annuity payments. However, they wouldn't have accounted for the tax in that specific year. Okay. Now, what's interesting here is that they are now trying to look at all the different types of annuities that you receive, and they would like to cater for tax payable on those annuities so that there isn't a high tax paying at the end of the tax year on assessment. In order to remedy this anomaly, Treasury intends to introduce legislation that will account for all sources of annuity income received by the taxpayer. The paying entity will apply the income tax table at onboarding of the annuitant and will then apply a fixed rate of tax as provided for SARS in subsequent tax years. Once again, this is proposed to go effective, to become live 1 March 2022. So what they're suggesting here is what will happen is on the first year that you have to apply the tax rate, you will apply your income tax tables, okay? And thereafter, you will receive a fixed tax rate from SARS, and the paying entity will have to apply that fixed tax rate, okay? And the intention is obviously for that fixed tax rate to consider all the various sources of annuity payments that the annuitant receives. Okay, the next one is around retirement fund transfers for members older than 55. Okay, transfers between retirement funds are taxable events. However, current legislation allows for certain tax-free transfers. Okay, this exemption, however, does not apply to some members who have already reached their normal retirement age, however, have not chosen to retire from their retirement funds. And the proposal here is for Treasury to amend legislation to allow for tax-free transfers for those members who have already reached their normal retirement age in terms of their fund rules and have not yet chosen to retire into a similar type fund. Okay, once again, the effective date proposed here is 1 March 2022. Okay, the last slide I just want to quickly talk about, and you'll see this, it's been getting a lot of media attention, even though it wasn't in the Taxation Laws Amendment Bill. I just want to quickly address it, and that's in terms of access to retirement savings, or I should say, early access to retirement savings. And you would have seen that there was a media statement that was released by Treasury, and there has been articles around it, where Treasury has recognized that a lot of members are, go through hardship before retirement, and they want to introduce a way to allow them to access retirement funds prior to then. Okay, I can tell you that it's nowhere near being just, effective. There's lots that needs to happen before that actually happens. Discussion with industry is quite a big one that needs to happen. Okay, National Treasury is busy drafting framework. Okay, the intention is for it to be finalized by the end of the year. They would like for it to go live by 2022, but I can tell you there's lots of work actually to go through before that goes live. And what they intend on doing is, at this moment, is introducing a 2-bucket system where 1 bucket you can access prior to retirement on certain conditions, and the second bucket, whatever that might be, whether it's 2/3 or whatever that portion is, will be forced, compulsory saving to get to retirement, and you'll only be able to access it at that point in terms of an annuity, okay? And you won't even be able to access it on resignation, whereas you can at this moment. Okay, the proposal was not included in the draft Taxation Laws Amendment Bill, but we do have indication that there is some urgency in terms of this, and that we probably will see drafts on this very soon, but we will keep you updated. And that's it from me. Trev.
Denver, thanks for that. That was great.
Cool.
I know you're the tax-free investment specialist. This is your chance in 30 seconds to plug for business.
Well,
no, any changes, and just remind everybody about tax-free investments.
Well, I think the one big thing is that we have been listening to our clients and to our financial planners in terms of we need to provide a seamless journey for clients to benefit from tax-free investments. We want to address a lot of the admin issues that we currently have. And I think in our digital space, with all our client journeys that we are building at this stage and that we're really looking at, we're trying to accommodate for that. And I think Ashraf and his team have been doing a fantastic job in terms of creating a seamless journey for tax-free investment clients.
Great. Denver, thank you so much. Get home safely, stay safe, stay healthy, and great to see
Will
you.
do. Thanks for having me, Trev.
Pleasure.